The S&P 500 is taking a big hit today. So what's next for the stock market? Is it time to go long at a discount, or is this the beginning of a much larger move down in the markets? Now, to understand what we're going to say in this video, you need to know that this has been one of the most hated rallies in history. The number of bullish investors throughout this entire period stayed at around 20%. That means most investors missed out on this massive rally. And we can see this on this chart. This is the rally off the March low, the stock market rally. And this is the percentage of bearish investors. And you can see that percentage has consistently stayed at around 50%. So again, we can say most investors missed out on this rally. Now today, something very important happened, something that we've been waiting for a long time. Investor sentiment has finally flipped to bullish. There are now more bullish investors than bearish ones. The majority of investors are finally optimistic about the stock market. And we've talked about this specific moment coming for a long time. This is the moment when the stock market starts to get risky. And this is also the moment where you should consider clicking on the like button on this video. It helps our videos get pushed to a wider audience tremendously. So thank you very much for doing that. And we do mean starts to get risky. Of course, if we have more good news around the economy, like stimulus, vaccine news, good economic data, that can still trigger a major move up in the stock market. There is still 60% of investors that are not bullish and that are waiting to deploy their capital in the stock market. If we have these kinds of news in the media over the next few weeks, it will trigger fear of missing out rallies. And that is something we expect. So why is the stock market risky? And more importantly, why does bullish sentiment make the stock market risky? We're going to go back to this survey and we need to imagine, let's say 100% of investors are bullish on the stock market. So that's an extreme level. That's something that never happens in the stock market. But for argument's sake, let's say 100% of investors are bullish on the stock market. And so nobody's neutral and nobody's bearish. You can imagine that the slightest bad news around the economy, around politics, around world trade could trigger some of those bullish investors to flip to neutral or to flip to bearish. And so this situation is what we call priced in for perfection. And any slight bad news will cause some investors to flip to neutral or bearish, sell their positions, and make stocks fall. So that's why the stock market is starting to get risky. We expect the markets to continue rallying and the bullish sentiment to rise to extremes with it. This can be very dangerous in the current stock market, as we're going to explain further in the video. But also in the short term, investors must be aware that the stock market is now much more sensitive to bad news. If we start to get rising number of cases, maybe some of those 35% of investors may flip to neutral or may flip to bearish. So that's what we've been talking about on gameoftrades.net. Yes, there is still a lot of potential for upside in the market, but there is also increasing potential for downside in the market as well. So we were waiting and waiting for a buy signal, which never came, and so we never got into a long position on the stock market. Now, the closer this percentage gets to around 50 or 60%, the more this becomes an extreme bullish sentiment. Now, normally that isn't a huge problem. Normally, extreme bullish sentiment comes at the end of a leg up. Then you get a correction shaking out some bullish investors, and then the market comes back up again. So that's usually how sentiment works. So why are we talking about a potential crash? And the answer is very simple: a stock market bubble. This is one of the charts that can illustrate why the stock market is in a bubble right now. This is a chart of the returns of growth stocks versus value stocks. This is something we've talked about before. Growth stocks are more speculative stocks. Investors are betting that the growth of the company will continue, whereas value stocks are considered to be underpriced companies relative to their actual value. So you can see this chart. This is the dot-com bubble. Throughout this period, growth stocks outperformed, and here from 2016 to 2020, growth stocks outperformed massively. So what does this mean exactly? It means that a huge portion of the stock market right now is overvalued and became overvalued very quickly in just 4 years. As we've said before, growth stocks are great when everything's doing well, but they are speculative in nature. You are not investing in value, you are speculating that the growth will continue, which are two very different things. So these bubbles tend to end when sentiment gets extremely bullish. We saw this in the dot-com bubble. Sentiment peaked in 2000 right here, and the bubble popped for apparently no reason. And that's exactly what we're talking about. The stock market was priced in for perfection and was overvalued. You can have extreme bullish sentiment by itself, and it's not that bad. You can have overvalued, and it's not that bad. But if you have both at the same time, that can trigger the popping of a valuation bubble, which is clearly a problem we have in the stock market right now. So we can look at how the sentiment was during the dot-com bubble. So this is the same chart as before, but this time we're looking at the number of bullish investors as opposed to bearish investors. And you can see this major spike right here at the top of the dot-com bubble. This was early 2000. We had a spike with 75% of investors being bullish. Now this is the S&P 500, so it doesn't show you the bubble, the tech bubble that we had during the 90s, but that did almost correspond exactly to the top of the dot-com bubble. So that's the moment where an overvalued stock market was priced in for perfection. It only had downside left. It almost seems like it popped for no reason, which is absolutely not true. Bubbles are entirely based off investor psychology, and so they pop when the hype has ended. So that's what we still believe is going to happen in the stock market over the next few weeks. We're not looking for shorting opportunities just yet in the market. We have much better trades to make elsewhere. Now, this is a significant breakdown, so that is still a very possible outcome in the next few weeks if we get more good news on the economy. So the stock market is a risky place. Be very careful out there. If you are an investor and you're looking for long-term gains on your investment, there are much better opportunities than the S&P 500. We've covered many times that stocks are unlikely to be profitable long-term. We do expect a blow off top in the next few weeks, but it is a risky trade to make. So we're going to continue looking at those opportunities over the next few weeks. And I couldn't make this video without at least talking about the alternatives, because there are clear alternatives. Now on gameoftrades.net, we look at precious metals a lot. We look for new opportunities every day. Gold has a perfect track record. It's undervalued and the bull market is just beginning. We're actively trading it and we're continuing to look for long-term opportunities. And we're going to continue to look for long-term opportunities as it moves higher in the next few years. Now we also love Bitcoin. We recently had a nice breakout that was covered on the site, and we talked about that breakout potentially tagging the top of the channel. That's exactly what happened. Now it is riskier. Bitcoin is definitely riskier than gold. We don't know how it behaves during periods of deflation. We saw the crash of Bitcoin throughout the health crisis. It was a very ugly time. It was a very bad time to be invested in cryptocurrencies. So this definitely shouldn't be the majority of your portfolio long term. We don't have enough data. We don't have a large enough track record on Bitcoin to predict precisely where it's going to be going. That being said, the future of the financial system will run on cryptocurrencies. So not only is this a technological revolution that has immense value, just look at the market cap of Bitcoin. It's at $200 billion, which is nothing if you really understand what Bitcoin represents for the financial system. We think Bitcoin could exceed the market cap of gold. It has more intrinsic value than gold. And gold has a market cap of $9 trillion. So there's a long way to go. And it's also a safe haven, just like gold. It's anonymous. It's virtually impossible to ban. There's a limited supply that cannot be manipulated. So it's also the best possible hedge against inflation. We really love the concept of Bitcoin. So between these kinds of assets and a stock market which is overvalued and overleveraged, we are heavily weighted in favor of the former. So that's all I wanted to cover in this video. If you enjoyed, make sure to drop a like on this video and subscribe to the channel if you haven't already. In the meantime, good luck on your trading and see you next time.